the place where we cut through the noise, distill complex analysis, and give you what you need to be fundamentally well-informed.
Today we're looking at a fascinating study in market psychology. It's a classic contrarian setup.
An analysis report on Fermi Inc., ticker FRMI. And the core tension here is just unavoidable. You have a stock that, in the words of the report, has been absolutely hammered. It collapsed, what, nearly 70% from its peak?
Yeah, it made it one of the most hated stocks of the last 2 months. A lot of people betting against it.
And yet, despite that, the Wall Street consensus maintains a price target that suggests, and this is the incredible part, a path to tripling from here, a 250% upside potential.
It's a staggering paradox. You've got the market screaming, get out, while the analysts are quietly saying this is a massive opportunity.
Right.
We have to figure out who's right.
So let's just nail down the numbers on that volatility.
Yeah.
The stock went from a high of almost $37 all the way down to a low of $7.28.
Brutal. Just an absolute collapse.
It's trading now around $8.80. So the central question for us today is, how can a stock that just fell off a cliff, even with a recent 10% pop in one day, how can it realistically support an average target of over $31?
Well, that surge you mentioned is actually a key part of the story. It shows that big money, institutional money, might be starting to step in.
Rejecting those lows.
Exactly. This kind of discount on future potential, this is precisely where the analysis report says smart money starts looking for a position.
Okay, so here's how we'll break it down for you. First, we need to understand why the stock collapsed in the first place and why analysts think it's an overreaction.
Then we'll get into the huge macro story, the bull case that connects FRMI directly to the AI energy crisis.
And finally, we'll look at the math that gets us to that 250% upside and the technical signals that suggest the bottom might finally be in.
Let's do it.
All right, let's start with the elephant in the room, the chaos. Why did FRMI crash from $37 to below $8? This wasn't just the market having a bad day.
No, it was very specific. The analysis points to two immediate triggers for the panic. First, they ran into some issues with tenant contracts.
Okay, so that creates uncertainty about revenue.
Big time. It spooks investors. And second, and this is the bigger one, the company is in a massive build-out phase. It's an infrastructure play.
Meaning they're spending a ton of money.
A ton of money, burning cash to build the things that will make them money later. So the market saw cash going out the door and short-term uncertainty and just hit the sell button hard.
So they're being punished for doing the very thing their business model requires, which is building long-term expensive infrastructure.
Precisely. It's that classic conflict, short-term market demands versus a long-term vision. The whole contrarian view in the report is that this price drop was a massive overreaction.
It says the current price is treating the company, and I'm quoting here, like it's going bankrupt.
It is, which seems extreme.
But wait, if they are burning cash that aggressively, isn't that a legitimate red flag? Why shouldn't investors be worried?
It's a fair question, but that's where the analysis pushes back against the fear with, hard numbers. The counterpoint to the bankruptcy narrative is simple.
The cash on hand.
The cash on hand. Fermi Inc. is sitting on over $180 million in cash.
$180 million. Okay, that's not chump change.
Not at all. That's a substantial runway. A company with that much liquidity isn't on the verge of collapse. It's a company in a high-growth phase that just hit a speed bump with contract timing.
And that cushion, the analysis argues, completely flips the risk-to-reward calculation.
It does, and you can see the market starting to maybe realize that with that recent price action we talked about.
That 10% surge, over 80 cents in one day on huge volume.
Yes. The report calls that a high-volume rejection of those lows. It's a signal. It suggests that buyers, likely institutions, stepped in and aggressively defended that $7 level. It might be the first real sign of a shift from panic selling to accumulation.
Okay, so the short-term picture is clear. A panic sell-off, but with a strong financial defense. So let's zoom out. Let's look at the future potential that's justifying that crazy $31 target. The macro thesis.
Right. This is where it gets really interesting. The bull case has almost nothing to do with their current quarterly earnings. It's all about a huge global problem that they are positioned to solve.
The AI energy crisis.
Exactly. The report is emphatic on this point. The world is facing a severe, and I mean severe, power shortage, specifically for next-gen AI data centers.
Forget about the hardware like NVIDIA's Blackwell chips. They're just, they're energy hogs. They need a staggering amount of power to run.
Staggering is the right word. We're talking gigawatts. And for an AI data center, it's not just about the amount of power, it's about the reliability. It has to be on all the time, no exceptions.
And that's where Fermi Inc. fits in. They're described as a pure play on hyperscale energy.
Yeah, because they're not just another utility. They are developing nuclear and other high-efficiency grid solutions specifically for this problem. They are building the power plants for the AI revolution.
So if we were to boil it down, what are the three pillars of this bull case?
The analysis makes it pretty simple. First, demand is essentially infinite. The biggest tech companies in the world are desperate for the power that Fermi is promising to build. They have to have it.
So a captive audience with deep pockets.
The deepest. Second, scarcity value. This is key for the stock's valuation. There are very, very few public companies doing exactly this. If they succeed, they could command a massive premium. The opportunity created by the panic. That sell-off we discussed means you can now buy into this massive, long-term story at what the report calls fire sale prices. The risk-reward is skewed heavily to the upside right now.
That paints a very clear picture. A bet on essential scarce infrastructure. So let's get to the math, because a 250% upside is what makes it so provocative. How do analysts get from a stock at $8.80 to a target of $31.50?
They're essentially looking past the current construction phase and modeling out the future cash flows once these power facilities are actually online and selling energy to those big tech tenants.
And despite the stock getting crushed, Wall Street's consensus hasn't really budged.
Not at all. It's still a strong buy. The average analyst target is right around $31.50.
Which from $8.80 is a 258% gain.
It is. And it's worth noting the high target from some analysts is $37.
Right back to its previous peak.
Exactly. Suggesting that for them, the long-term value of the company hasn't changed one bit. The market just got scared.
So what they're saying is the market has priced in maximum fear, completely ignoring the future value of these assets once they're built.
That's the argument. And the great thing about that much fear being priced in is that you don't even need the stock to hit $31 for it to be a huge win.
Just a recovery to the midpoint would be a double.
A recovery to $16 is more than a double from the lows. It frames the immediate potential really clearly.
So what could be the trigger? What's the catalyst that could start that move? Especially with so many people betting against it.
No, that's the thing. That downturn created what the report calls a crowded short float.
A lot of short sellers.
A lot. And that creates a coiled spring. Any piece of good news could force those shorts to buy back their shares to cover their position.
A short squeeze.
Which could lead to a very rapid, very explosive move higher back into the double digits.
And what kind of news are we looking for? What's the specific trigger?
It's all about execution. The report points to three things. A new major tenant contract gets signed. That's the big one.
That would erase a lot of the recent fear.
Instantly. Or a simple construction update that shows they're on schedule. Or a strategic partnership. Anything that validates their plan and chips away at that wall of worry.
Okay, let's look at the chart then, the technicals. What was the signal that the selling pressure might be over?
It's a really compelling chart right now. The big 10% up day, it created a specific pattern that traders look for. It's called a green Marubozu type candle.
Okay, for those of us who don't live and breathe candlestick charts, what does that actually mean?
It's just a really powerful signal. It's a long green candle with almost no wicks on the top or bottom. It means the stock opened near its low for the day, let's say at 809, and the buyers were in complete control all day long, pushing it to close right near its high at 882.
So there was no fight from the sellers?
None. It suggests the sellers are exhausted. They're done. The pressure has shifted from panic selling to potentially accumulation. The big money is stepping in.
Okay, so if you're tracking this thesis, what are the key price levels to watch?
The analysis gives us two really clear lines in the sand. First is support. The absolute floor is the recent low, around $7.30. As long as the stock stays above that, the bull case is considered intact.
And on the upside, what's the level that would confirm a real reversal is underway?
You want to watch for a clean break above $9.50. If it can clear that hurdle and stay above it, the report suggests the gap to $12 fills very quickly.
So that 950 level is the key. It could unlock a much bigger move.
That's the first major resistance. Clearing it would be a very bullish sign.
All right, let's wrap this up with the verdict, the risk assessment. This all sounds great, but it can't be a sure thing.
Oh, not at all. And the report is extremely clear about this. It calls FRMI speculative, volatile, and my favorite, not for the faint of heart.
And this is a high-risk play.
It's an infrastructure bet on the future. That 250% upside is entirely dependent on one thing: management's ability to execute. They have to build what they promised and manage that cash effectively.
So let's synthesize this for you. What does this all mean? You have an infrastructure company with a massive long-term tailwind, the AI energy demand, but it's being punished right now for short-term problems, cash burn, contract delays.
And the argument in this deep dive is that the punishment has been way overdone. That the market has created a situation where the risk to reward has fundamentally flipped, giving you a chance to get in on a massive growth story at a deep, deep discount.
The report frames this moment as the bottom potentially being in. If a company executes, that 250% upside is on the table. But we want to leave you with a final thought to chew on. If the market is truly pricing in maximum fear right now, what single piece of bad news, short of actual bankruptcy, could realistically push the stock below that critical support level of $7.30?
That's the real question. It comes down to execution risk, a failure to land that next big contract, a major unexpected delay in construction. That's what you have to watch for.
That's the razor's edge between a historic recovery and just